Hello, everyone, and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. Before we begin, standard disclaimer, nothing here is investing advice. Do your own due diligence. And today's guest is the managing partner and fund manager at Incrementum AG and one of the contributors to the renowned In Gold We Trust report, Mr. Ronald Stöferle. Welcome to the program.
Hi, Jesse. Thanks for having me.
Thanks for being on. You are one of the guests I have most wanted to have on the show, so I'm very excited. And I want to begin, like I do with all new guests, with their origin story. So let's go back and let me know what drew you to investing to begin with and ultimately led you to the precious metal space.
Well, I mean, it's a long story. I started investing in stocks when I was 12 or 13. I was always fascinated by analyzing companies, by reading charts. And when I was still in high school, I was really big in the dot-com boom. And I wanted for my graduation, I wanted to buy a Ferrari F40, I think. I just loved that car and drive with that Ferrari to my graduation party. Well, actually, after the dot-com boom, there was the dot-com bust, and yeah, I took the tram to my graduation party. But I've learned my lessons there, and then I started studying finance and economics, and continued investing, and started working as an analyst in a bank in Vienna. And I don't know. I think it was a coincidence. A friend of mine said, "Well, you gotta invest in this gold stock, in this gold mining stock," and I didn't have any clue. And it ended up as one of those very, very few exploration companies that really go into production. So that was Osisko Exploration back then, and it turned out to be a 40 bagger, which was a blessing but also a curse. Yeah, because I thought, well, junior mining, that's pretty easy. um, but this really got me interested into the topic of gold. And they don't teach anything about gold in school or in university. They don't teach the Austrian School of Economics. Even here in Austria, you don't learn anything about our monetary system, especially when you're studying economics and finance. So I basically swallowed the golden pill and started reading about gold, about our monetary history, about the Austrian School of Economics, and started writing about gold. And this was the first In Gold We Trust report. And now, 15 years later, well, we are still publishing the In Gold We Trust report. Roughly 400 pages for the last edition. We're publishing in German, English, in Mandarin, and also in Spanish. We've got many chart books that we publish. And I have to tell you, the topic of gold still fascinates me. I'm still learning every day. And I think, if you want to put it in a nutshell, if you want, or if you try to understand gold, actually, then you have to understand and research various different topics, be it, of course, interest rates, then the development of currencies, opportunity costs, for example, equities and bonds. You have to understand geopolitics. You have to analyze technological developments. Obviously, we're also writing about the mining stocks. We're writing about what actually a certain allocation of gold does to your whole portfolio. So, as I've said, it still fascinates me, and it will probably never get boring for me.
So let's touch on the In Gold We Trust report, an amazing report. You mentioned how long it is. I would advise people to take a look. That sounds daunting, but it's structured in such a way that it's actually pretty easy to get through. So could you highlight the main themes from this year's report, how you've seen those play out so far? And now that we're almost in 2023, how do you see gold performing as we cross over into the new year?
Yeah, well, I mean, this year's report is quite lengthy again, but there's also a compact version. But I don't know if you can see it on the cover. You see a wolf, and then there's um, a little bear coming from the back, and it's still kind of hiding. And the reason why we chose this cover design was that in 2020 we wrote a special report called Inflation and the Boy Who Cried Wolf, and we said actually inflationary risks are rising, and this would really be the point in time to slowly and cautiously start thinking about rate hikes. So that was fall 2020, and we know that basically almost 2 years later, they still told us, well, it's only transitory. Inflation isn't a big topic; it will come down. Stagflation isn't something that we see. So actually, I would advise some people at the ECB and the Federal Reserve to read our In Gold We Trust specials more often, because that was actually spot on. But um, we chose the wolf, which stands for inflation, and then also the bear as the leitmotif. And we said that actually um, the bear stands for the recessionary risks that are actually rising, and we see that central banks reacted very, very late, but then they reacted decisively, especially the Federal Reserve. And we have seen over the last 8 months 375 basis points of rate hikes in an environment of the probably most over-levered economy. The balance sheet of the Federal Reserve has almost doubled within the last 2.5 years. We're seeing total non-US financial debt um, we I think it's 67 trillion. From my point of view, the sensitivity to rising rates is enormous, and therefore this is really an accident waiting to happen, and it's already happening. So we said, well, inflation is the topic now, but prepare for a recession that is coming up. So that was basically the leitmotif, and then we analyzed how various asset classes perform in a stagflationary environment. We came up with our own proprietary definition of stagflation, and we compared the stagflation of the 1970s to the current stagflation. And actually, um, the level of debt obviously is one of the most important differences when we compare it to the 1970s, not only on a government level, but also on a company level, on a household level. Debt levels are actually twice or almost 3 times as high compared to the 1970s. So therefore, I don't really buy into the narrative that Jay Powell is the new Paul Volcker. And then in the report, we also talked about, the commodities bull market that is mainly driven from the capex cycle. We analyzed what ESG actually does to the commodity universe. We talked about the de-dollarization, obviously, that has become one of the most central topics this year. Yeah, so I think it's still an interesting read, and actually our ambition is always, if there's just one report a year that you want to read to understand gold, it should be our In Gold We Trust report.
I agree, and I would like to touch on what you spoke to, de-dollarization. Do you think the dollar dominance will eventually come to an end? If so, how? And we have the BRICS nations discussing creating an alternative reserve currency. We have nations moving away from the US dollar when it comes to transacting in commodities. How do you think this all ends?
Well, actually, I think that we are writing about this de-dollarization already for I think 6 or 7 years, and we always said it is a process, and I think this process clearly picked up momentum this year. So Russia and China have long sought to de-dollarize. This is not a new phenomenon, but it has slowly been playing out since the end of the Cold War. And although things are not going that well in the West, I think that BRICS are also undergoing hardships at the moment. So obviously the war for Russia, the lockdowns that we're seeing in China, new political regime taking power in Brazil, extreme mismanagement in South Africa, and so on. They clearly lead to a situation where we are seeing kind of this polarization between the West and the rest of the world. So it's basically the BRICS Plus or the SCO, the Shanghai Cooperation Organization, and this is really speeding up on many levels. So we are seeing it with social, political, with ethical, cultural, economic differences dividing. It is clear that um, um, actually this monetary polarization is probably the next major step. And I think we have seen this year that Russia and China are kind of sick of sending real goods, resources in the case of Russia, and manufactured goods in the case for China to the West in return for paper money. And this decision by the European Union and the United States to actually just with the how do you say, with the stroke of the pen, to wipe out, I think, 640 trillion of currency reserves that the Russians held. I think this is actually a very important information for many other countries that are somewhat critical to the United States, and that actually playing more of the realpolitik game. So I think that those nations have clearly seen that actually you want to own something without any counterparty risk, that is accepted all over the globe, that cannot be inflated at will, and that is highly liquid and accepted, as I've said, all over the globe. And I think that's a pretty good, pretty strong additional case for gold, actually. So this de-dollarization is going on for a while now. We are seeing so many different agreements, trade agreements, and how those countries settle, in which currencies they settle their deals. But I think this de-dollarization topic has clearly picked up momentum this year.
I want to get your thoughts on silver now. A huge part of silver's potential comes from its industrial applications, which a lot of people don't consider. Especially these days, there's been a lot of talk of solar panels and silver, to the point where I even interviewed Doomberg not too long ago, and their team believes that without demand from solar, the price of silver could actually collapse. So I'm wondering, from your perspective, is the solar industry really such a massive part of the silver thesis? And are there other tailwinds operating in silver's favor at the moment?
Jesse, I think that's a great question, and I think that Doomberg actually said, if the demand for silver from the from solar panels would completely disappear from one moment to another, that would obviously have dramatic consequences, which is right. But I don't expect that it will from one day to another just disappear. So I had a look at the data according to the Silver Institute for 2021. So total silver demand was around 1 trillion ounces, of which 113 million ounces was for solar panels, for photovoltaics. It is forecasted to rise to 127 million ounces this year. So of course it is a driver, but I would say that it's somewhat stable, and from my point of view, I mean, we installed solar panels on our roof this year, and I have to tell you, if you really want to make money, you got to be an electrician these days. So I talked to the electrician, and first of all, he said, and I thought that it was really interesting. He said we're living now in a war economy. So tiny parts that are necessary, like little screws, really not super sophisticated stuff, he just doesn't get them. Yeah. Um, but then I was talking about silver, and he said actually, those panels, of course, there's enormous technological progress because there's so much capital and so much innovation in that space. So actually, we're seeing that those solar panels are becoming more and more efficient. So you need less silver actually for those solar panels. Um, and of course, due to the high conductivity, you need it for solar panels, and it is only, like, I think 5 or 6% of the total cost of a solar panel. But I think there could be other options available over the longer term. For the time being, silver is still the best choice, but I think if the price of silver should increase dramatically, silver could be at some point substituted. So my thesis is actually I don't buy into this narrative that silver will profit from this. I don't know, this green wave or whatever it's going to be called. From my point of view, silver is just primarily it is a high beta play on gold, and I think that silver is holding up really well at the moment. Um, so if you expect a stronger gold price, obviously silver would be a good choice, a levered play on a rising gold price. And I think this should really be the main reason to buy silver, while I think the whole solar demand is a bit overrated.
I want to get your thoughts on the FTX meltdown and the general collapse of the crypto market. I personally separate Bitcoin from crypto. I'm long Bitcoin. I've actually never mentioned that before on the show. I know the gold and silver bugs are going to have something to say about that in the comments for sure. But where do you see the industry headed from here? And do you think we will see some of that speculative money that was going into crypto flowing into the gold and silver sector, maybe into the mining sector?
That's a great question, Jesse, and I have to say that we run two funds that actually combine a physical gold with Bitcoin. So that the one is 75% physical gold and 25% Bitcoin in cold storage, with an options overlay where we actually use the enormous volatility of Bitcoin to harvest the volatility from the options market. And the other one combines gold, silver, mining stocks with Bitcoin and some smaller other cryptocurrencies. So I'm a free markets guy, and from my point of view, why shouldn't there be any competition when it comes to currencies? Yeah, like Hayek said back in the days. So from my point of view, I don't like the fact that there's like two camps, like the gold camp and the Bitcoin camp. Both should be in the sound money camp, and I think that um, the inventor of Bitcoin, whoever it was, clearly understood our monetary system, clearly understood how gold works, clearly understood the stock to flow ratio, which is crucial for the for something to become money actually. So I regard gold as a very old and established monetary technology, while with a couple of thousand years of trial and error, while Bitcoin clearly is a much newer monetary technology. Um, and the reason, that's it's pretty obvious that the volatility therefore is significantly higher. Um, I think when it comes to FTX, it just shows you it's not the problem of Bitcoin. It's if you say like, well, there was the whole Enron scheme, and then you blame capitalism, or you blame I don't know, companies or whatever for that. We can just see, and I expect much more of that to happen, not just in the crypto space, but as Buffett said, when the tide goes out, you see who's been swimming naked. So I think all those things are just a consequence of this enormous monetary tightening that we experienced over the last couple of months. Not only the rate hikes, but also quantitative tightening and the strength of the US dollar. So when do bubbles usually pop? When cash flows suddenly disappear. And I think that the whole FTX scam, although it is sad to witness, but it is let's say, the necessary school fees that greedy market participants will need to pay, because they don't understand the crypto space, which is lots of scams and high risk regulation arbitrage. Let's put it that way. So therefore, I think it's not the problem of Bitcoin itself. It just shows that you have to be very, very careful when it comes to crypto in general. It shows what um, cheap money and ample liquidity does to a market. Of course, it blows up bubbles, and as soon as the liquidity disappears, those bubbles pop. So for Bitcoin, I think um, it's crucial, like with gold. Yeah, I think a stable or safe storage is key. And it's pretty obvious. I mean, you shouldn't leave your bitcoins on an exchange. It's like if you leave your wallet on the table when you're in a cafe or in a bar, and then you go to the washroom and you come back. Well, you know, I don't know if the wallet is still gonna be there. It's just a risk, yeah. And of course, it depends on the country that you currently are, and the safety of that current country. But it's just not a smart decision to trust everyone else and just leave it there. So regarding Bitcoin, I'm pretty much relaxed. I know that Bitcoin is a very emotional topic, like gold. Gold is also a very emotional topic. Everybody wants to have an opinion on both. While when it comes to, I don't know, convertible bonds, for example, or I don't know, corporate debt. Yeah, I mean, people couldn't care less. But for some reason, gold and Bitcoin are super emotional, and I think as an investor, you should leave emotions aside, and that's what we try to do.
Absolutely. I think some of it comes from the smug Bitcoiners with the laser eyes who are talking about have fun staying poor and who are constantly talking down about gold, how Bitcoin is the new
Yeah,
gold. And then you have very few people who are precious metals proponents who also advocate for Bitcoin. There's only a handful I can think of, yourself, Lawrence Lepard, maybe a
yeah.
few others. So I definitely think we need the sound money camp needs to come together and because we're fighting for the same cause in the end. I would like to get your thoughts on the energy crisis in Europe because both of us live here. In Croatia, where I'm located, we haven't really seen any dire impacts. Could be because of a small population size. But what are you seeing in Austria, where you're at, and other areas you've been traveling to in Europe? Is this whole narrative about the deindustrialization of Germany, for instance, is that a real thing, or have the headlines been exaggerated? What do you think?
Well, I think, if we take a step back, I think it's crystal clear that um, starting in 2020 with the COVID crisis, um, we all got so used to getting government subsidies, and actually, I know so many people that said, well, 2020 and 2021 were fantastic years. I was just, I was at home, did some work, but actually I watched Netflix all the time, got all this money from the government, and it was just great. I was drinking red wine, did lots of sports. Yeah, everything was fine. So I think that people really got used to that. Um, and I think also politicians got used to that, because actually, um, um, politicians tend to like staying in power. And if you hand out like I could call it helicopter money, basically, to people, of course, that buys votes. So I think it was interesting. I attended two conferences in Colorado in September. So compared to the United States, where people were pretty concerned regarding energy prices. Obviously, they drive much bigger trucks, and gasoline is just a bigger part of their spending. But I think um, they don't they didn't really expect that governments will take care of that, while compared to that, over here in Europe, it was crystal clear that the government is going to take care of it, and put in ceilings for prices, hand out lots of money, um, bail out all those utility companies that actually um, weren't able to hedge their natural gas. So I think, the amount of government handouts relating to energy is enormous. We've seen it in the UK, we've seen it in Italy, in Spain, in France, in Denmark. in Germany and in Austria, in the Netherlands, all those countries have subsidized energy or are handing out huge amounts of money to their citizens. So I think, the solution is capping prices, but actually that's not a real solution. Yeah, that's just kicking the can further down the road. So um, I think, the whole Russian crisis is obviously just the catalyst and the trigger for the energy crisis. But the main reason is systemic underinvestment. And obviously, some countries are much more reliant on Russian energy than others. Austria, for example, imports more than 80% of its natural gas from Russia. Um, so if we want to make a somewhat positive case, Jesse, I would say that 2022 is actually the year when people and also politicians actually realized, well, commodities aren't a bad thing. Commodities are something that are, actually the basis, the foundation of our industries. Yeah. Um, so I am seeing, when it comes to uranium, for example, but also to when it comes to critical metals, I see that politicians kind of woke up way too late, obviously, and it will take years to solve those problems. But I think there's definitely a paradigm shift happening when it comes to commodities.
So let's talk about maybe some of those opportunities that are presenting themselves as a result of the energy crisis. You mentioned uranium and nuclear. I'm long uranium, but obviously, in terms of solving the energy crisis, like you said, that's years and years away from enough reactor buildouts happening. I see, oil and gas presenting an attractive opportunity over the shorter time frame. I'm curious to hear your thoughts on that.
Well, I think, there were two huge trends in asset management over the last couple of years. First of all, passive investment. So everybody said, well, let's just buy an ETF. You don't need active managers anymore. I think that 2022 actually changed quite a lot. And the second big trend was obviously ESG. So, this whole new Green Deal, it's kind of a nice thing, yeah, and obviously something has to be done, but I think that people forget the mathematics behind it. Yeah, it wasn't thought through from my point of view. So this is something that really takes decades, 20 or 30 years, but it seems that many want to do it over 2 or 3 years. So I think that the whole Green New Deal thing scared everybody in the energy space to death, and now we are starting to realize that we just cannot get rid of the energy sector and fossil fuels for quite some time. So I think that all those developments, for example, from the International Energy Association, they published their net zero by 2050 report, and one of the recommendations was no new oil and gas fields being approved for developments after 2021. So I said back then that, well, ESG will come back like a boomerang in the form of inflation, and that was really spot on. So if you have a look at the capex cycle and how much the large companies actually invested over the last couple of years, it is crystal clear that it has to lead to falling supply and higher prices. So therefore, I would say that if you really want to understand tight energy markets, you should have a very close look at the capex cycle. So this is one thing. Then I think when it comes to uranium, for example, we run one uranium fund here, one of the very few worldwide, and actually, 2 years ago, we really had a hard time marketing the uranium fund. Now, actually, nuclear goes green in Europe. So we have seen the EU Commission with their taxonomy, which basically says that nuclear energy will now be included as a part of the green agenda. Um, However, As we've seen in Finland, for example, building a new reactor, it takes a while. I think in Finland, it took them like 15 years. So, just to put those numbers into perspective, those three German nuclear power plants that where they kind of extended, um, they extended their how do you say, their time. Well, actually, I think they should have gone by the end of 2022, and now after long discussions, they extended it. That would have removed like more than 4,000 of megawatts of electricity. This is the equivalent of the average electricity consumption of all of Denmark. So it's really it's significant. So from my point of view, nuclear power will be needed for at least for this transition phase. It is reliable. It has zero emissions. It has a very, very high energy density. It has actually a pretty small land footprint, and it has a very, very low operating costs. So it's actually like 2 cents per kilowatt hour. So I think also here we're seeing lots of progress when it comes to technology. I am seeing um, some troubles ahead when it comes to skilled labor. Obviously, this is an area where it's hard to find really knowledgeable people with lots of experience. And if you find them, well, you gotta pay them well. But I think this 2022 has really been a change when it comes not only to commodities, but particularly when it comes to the acceptance of nuclear power.
I wanted to end on a tweet, a thread that the In Gold We Trust Twitter account recently tweeted about fractional reserve banking. And it ended with the question, do you think fractional reserve banking is ethical? Should it even be allowed to exist? Do the benefits outweigh the costs? What are your thoughts on this system and your answers to those questions posed? I think I know what they are, but we'd like to hear them anyways.
Well, moral and ethics, that's of course highly subjective, as we're seeing now when it comes to the World Cup in in Qatar. So they're, they change, yeah. They're somewhat elastic, it seems. But I think when it comes to the ethics of money production, there's a fantastic big book by Gude Hulsmann, The Ethics of Money Production, actually, which really analyzes, all those consequences, like the Cantillon effect and all those imbalances that are created. So, um, I think the Austrians are basically the only ones that actually want to discuss the ethics of fractional reserve banking, and um, well, would probably say that actually fractional reserve banking, the way it is being it is working at the moment, is not ethical. So I would say that the benefits of fractional reserve banking um, are substantial, obviously, and they create huge imbalances. Yeah. So what does it mean? The benefits for those creating and receiving and spending the newly created money versus those that actually receive that newly created money much later. Those benefits are substantial, and they create this huge gap that we are seeing between the wealthy and the poor. So the cost of this is basically borne by everyone not participating in this scheme, and still, let's say, accepting money for their work and goods. So this is kind of proportional to your wealth, which kind of means that the rich are getting richer and the poor are getting poorer because of fractional reserve banking, and therefore fractional reserve banking is probably not ethical. So it's really important for us to always really discuss and analyze the root causes. It is like if a smoker or if a patient goes to the doctor and say, well, actually, I'm having this bad cough, and the doctor then can say, well, take those antibiotics and a couple of other pills, and everything will be fine. However, if this person is smoking for 40 years, 2 packs a day, then probably the right solution to his medical problems is another one. It would be quit smoking and start a healthier lifestyle. Um, but for some reason, most people are not willing to really dig into those topics, to think and develop their own ideas and their own thoughts when it comes to those things. And so I think it's interesting because everybody is trying to make a living and trying to make ends meet, especially nowadays where inflation is rampant. But nobody really thinks about money actually, what money is, where money is coming from, how money is produced, what good money is, and yeah, therefore I think that our reports also. I think one of our missions is also to educate people about sound money and what it does to you and your savings. So yeah, long story short, I would say that our monetary system and fractional reserve banking are not really ethical.
I definitely agree with that. And I want to thank you so much for joining us today, Ronnie. For those who want to hear more from you, where should they go online?
Well, we've got a website for the In Gold We Trust report. It's ingoldwetrust.report. You can download all our publications totally free of charge. You don't have to register. We won't send you promotional mails or whatever. So you can download everything totally free of charge in all various languages on this webpage. We're pretty active on Twitter. My handle is at Ron Stöferle. And then, of course, we also publish lots of charts on the Twitter profile IGWT report. And then, if you want to have a look at our investment solutions, our funds, our wealth management, have a look at incrementum.li.
Great. I'll put links to all those in the description below. Great conversation, and look forward to having you on again sometime in the future to continue.
Thank you very much, Jesse. It's been a great pleasure. All the best.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.